Hey, good morning, guys. Ken at Tortoise Capital. It's the foundation's Q&A check-in for January 21st, 2024. And all stations reporting happy and healthy and good to go. So we're grateful for that. Spent some time with my sisters, my daughters and their one of them's fiance. They're all doing well. We had a nice Korean barbecue dinner. We ended up talking about uh, Teshi, which is it's a collection of Zuni Indian artifacts of um, Native American art, and they're very strong on animal fetishes as a focus on your inner work. So I can recommend their genuine artistry and the spirit behind it. The Zunis were like Pueblo Indians in the Southwest U.S. and my spirit guide, like three bears, turned me on to them. And so I bought a couple yesterday for the kids to kind of reflect where they are in their life story, and we had a good discussion about it at dinner yesterday. You can find them on Google easily, with Google pretty easily. Well, Jay asks, had some questions on the 5-day down trade, and was taking a look at core and turbo, critical states, mechanical entries, green, yellow, and red zones video. Again, this to me is the centerpiece of the way I think about the intraday trade. The principles of tiki-taka is how Barcelona thinks about playing with possession with the ball. That if we have the ball, they don't have it, they can't score. So if we have the ball, we keep the ball. We work for a shot. If we don't have the ball, we get the ball. Uh, Pep Guardiola, his version of that is called, get the ball, pass the ball, and just keep it. And Barcelona is magnificent uh, at that. That's sort of central to everything they do. That's sort of understood that no matter what particular uh, team formation they're using, the way they're going to play with the ball when they have the ball is centered on this idea of possession and patience and passing. And in the same way, I think of green, yellow, and red zones in the same way. Very, very fractal in nature. And again, the essential idea on any time frame, whether this is 5 days down or 1 minute bars, that for me, that vertical blue line is when I'm stalking, and when I'm when I haven't drawn the blue line yet, I'm studying. And I just, me, that means uh, yeah, I think I'm getting ready to prepare. I'm done planning. There was something about the pathway of Christ that brought it to this moment. Like this bar completed the pattern, or it got my interest. And maybe these could have been uh, Bollinger Bands. If so, then I've got a hint. going on. So that's always good. And then my basic frame is always uh, I I feel like I want to go long because that's where the herd goes. There's something about the power of greed in the herd, see, which is nothing more than seeking life, you know. So the herd, I feel the herd wants to go that way. So my feeling is I want to go that way too. I don't want to be left behind. And so it incorporates a buffer of 5 cents above and below that yellow zone, which says in the yellow zone, again on any time frame, if I am within the range of that last bar, I don't have any new information. No new info. So if I'm going to trade inside this region, I still have to have 2 to 1. So if I see a risk box here, then I have to have at least 2 units of reward. Then I can trade between the red line and the green line in either direction, whatever rules are going to apply for the time frame that I'm in. Because that establishes reasonable price limits in either direction. And it's reasonable because the previous day established those as boundaries between the bulls and the bears. And in general, in the green zone, if I see price in that region, then I feel like I want to be long. So I want to be long in that region. If I'm in the trade, I'm looking to be long. That's my priority. And remember that as long as this is moving up and it's leaving the yellow zone behind, that yellow zone acts like a great big magnet to pull things back into that range. So we have to achieve something like liftoff. Uh, it has to have some breakaway power in that explosive move in order to get to a point high enough that when it pulls back and then resumes, it never comes back to that yellow zone. And then we get caught at twos all the way up. So Jay then observes, as we said, it makes sense that if the market is in a bear market, to go short if the target opens lower and outside of the previous day's range. Can this be used to trade on the SPX? Provisionally, I will say yes. So your question really gets to what happens if it opens outside of the yellow zone? Because what I spent time on last session was what to do when it opens inside the yellow zone. I call that an orderly trade. Right. So by an orderly trade, I mean it is not exceptional. It's routine. So we've got that frame. And so that's where it closed because it's a white candle. And so if it opens here, then there's my gap. So now any open inside here in my view, is orderly. If you wanted to be technical, I'd be even more orderly if it opened inside the body, because that really defined the significant limits also. I mean, we don't know how much volume was transacted in the tails, but if that's the signal, and this is noise, I would say, especially if it opens inside the real body, that's even more orderly. So any entry along that boundary is really good. In a perfect world, the most perfect orderly entry would be as if it closed here and it opened here. That would be maximum orderly. But I really think as long as it's inside yesterday's range, it's still contained by the psychology of the buying and selling from the day before. Now, in the case of the 5DD, if this could be a white candle and that's still the close, as long as the previous four were lower closes from this last bar. And maybe that's the 10-day high, but it doesn't have to be. I'm going to draw it as if it were. Now, when we're trading the daily bars, the mechanical setup is treating this whole region as risk. And then we said it's not drawn to scale, but I have to have 2 units of risk to a reasonable high in order to have a valid trade frame. Now, it would be better if there was more. The more the merrier, the greater the risk. Then I'm going to also take a look at the way price descended this ladder, because if there was something like a intermediate support and resistance, like some action like that, I might further refine my trade frame and say, well, it would not be surprising if this thing broke out and then hit that region and then failed. But if it goes through that region, I'm going to take that as a piece of evidence that is affirming the move to the upside, that there's like this is confirmation that there is some strength because this is a test. That's support and resistance. Now, whenever I see that, if I see price gets through there and then starts coming back, especially if the RL10 reverses right in there, I'm really looking at this as that what used to be resistance is now support. For this thing to continue to get back to the 10-day high, I would expect it to hold here and then break through this level and off we go. So I will think of this now as the test. And then I would think of that as the emerging dragon, provided we had something like a peak in the RL10. So I really want to see that on the next pullback. I want to see that get through. And then as it comes down, I would like to see that hold. So that can just keep going. And then I have a series of successful tests and successful supports. And now I can start thinking of this whole process as a channel. And I can think of that if I take the midpoint of that channel, that feels like the power or the goodness or the quality of that move. And I'm getting some sense of price action oscillating in the bands of that channel. And as long as I have higher lows and higher highs, everything's right. So as I observe the width of that channel at any given moment, and I'm drawing vertical bands now to say what's the range of that, I can get a sense of what the normal movement inside that channel is. Now, as long as that's a smooth and orderly progression up the stack, it would not surprise me to see that the PSAR is outside of that channel. That's a good thing, because what that means is the PSAR, the rising PSAR, is giving me this little buffer for the normal oscillation inside that channel to continue to go. The next thing that I'm going to do is I'm going to look to see what is the dragon doing with respect to the PSAR. Once this channel starts filling up and going, then I should expect to see the dragon in between that price channel and the PSAR. And in a perfect world, that lower boundary of higher lows stays north of the rising dragon. That's perfect if that happens. If that happens, then you have tapped into a move that's just right. You love that. What you'd actually like to see is sort of the upper boundary holding steady too, so you don't have some exaggerated price move, which then comes back, because this feels almost abnormal. Like there was some new huge buying interest. Now, if you see that happening a lot, that just means that your channel is going to end up expanding, and you will see the RL10 begin to become asymptotic, and that's okay. But what I'm really doing is watching the shape of that dragon as it's cruising up. And then if the RL10 ever rolls over, maybe that urge is done. And then what I'm going to do is raise my stop from the PSAR to the top skin of the dragon and try to preserve some of this price gain that used to be the buffer when there was an orderly upward movement. That's good. I gave it a wider buffer. But once there was enough price decay that caused the RL10 to roll over, I now have this problem. It's starting to come down, and I have no information that tells me how far that's going to go, except if I look all the way back there and I see that red dashed line for the Bollinger Band mean 30, then I have to assume that the least surprising move of all is a reversion to mean, as expressed by the Bollinger Band mean 30, which is the middle of the river. Now, I've taken the extra Bollinger Band means off to unclutter, but in my mind, what I can see very clearly all the time is that there's some Z3 line. And as long as that price action was moving up, that's expanding. And then if I need to calibrate it at some moment of current time, if I take that vertical slice, I have a Z0, C plus 1, C plus 2, C plus 3, and then the space between the Bollinger Band mean and Z1 we think of as the river. That's where the crocodiles live. And then between 1 and 2 is the floodplain, which is really very, very healthy for growing crops. It's rich with alluvial soil. When the last time the river exceeded its banks, and the reason that it exceeded its banks was because price action, which had been chunking along in the river, suddenly broke out. And that upward movement of price is what yanked this whole price arrangement higher. And I have the RL10, and maybe that's as far as it goes. In a perfect world of normal rising prices with some rising and falling and all that, but as generally upward price action, you're going to see it living between Z1 and Z2. This is the normal place for price to live when you have an orderly move. Sometimes that move is so strong that it brings in new buyers and they come in with new buckets of money to take their position. Maybe that's a one-time buy. And when that happens, you may get an excursion past Z2 all the way out to Z3, and then no new buyers come in and it comes back into that channel. So you get this kind of spiky price action one time, and then it resumes, you hope. But that's almost bittersweet because now you realize that it's not just the normal group of guys buying this thing higher. In fact, if we get a move on one of those price spikes that gets outside of Z3 for one bar, and then it opens and doesn't make a newer high and comes back, we look at that as we call that the dragon horns. And that is a double top outside of Z3, which puts us on alert and says, you know what, that might just have been the last gasp of buyers in the current package. And when we see that, we're so far away from the reversion to the mean. That reversion to the mean is back here at Z0. And according to statistics, the least surprising move is that move all the way back to the Bollinger Band mean. So that's why when I see the RL10 roll, if that's this blue line is now the RL10, and it starts to roll over, even if there wasn't that spike, but when that RL10 rolls over, it says the least surprising move is going to be back to the Bollinger Band mean. And things being what they are, the price move back to the Bollinger Band mean should be steeper and faster than that long grinding walk up the stairs. So when I feel and I see that RL10 roll over, that's where I come back. And now instead of taking the stop on the rising PSAR, I raise that up to the skin of the dragon, usually, in order to preserve that extra piece of goodness. So in a world in which I have an orderly entry, that's the psychology of my normal trading behavior, that I can trade inside the yellow zone if I can see 2 to 1 inside there. And I can normally take that entry higher or that entry lower with this yellow zone as my mechanical 1R for calculation purposes based on a routine return to some price target, some reasonable price target. gave me at least 2 units. Hey, but what if, uh, and that so that return is in order to preserve whatever that breakout is, that's where I have to decide first, get to no lose plus dinner for two, and then pick some reasonable exit strategy that gives that move enough of a buffer so it can express itself. And my favorite is the PSAR. And if there's an exaggerated move up and starts to fail, maybe that's where I'm cutting it at 1 unit of risk in order to lock in most of that gain. So, how to preserve prices in here, other than picking the standard PSAR, that's where you're thinking about what we call sniper exits. And that is some judgment inside your head said, you know what, this was an exceptional move. It was so strong that I can't rely on seeing it again. So I better make haste to lock in the exceptional gains that were above and beyond normal. And if I have some kind of triggering judgment, I got to recognize that feels like either greed to keep what I have or fear of giving back what I have. And a decision to accelerate my exit above my regular managerial exit. I think that is just my hired day shift managerial exit of the PSAR. I'm using judgment to capture an exceptional piece. That normally happens when I see the dragon horns and the thing starting to roll over. And I just say, you know what? That's enough. I'm not gonna give back any more of that. If that dragon horn was outside of Z3, then that's an even easier decision. I'll get to that. I will answer that question in a minute, Joe, about the 3 and the 30. The primary answer to Joe's question was I'm not using the 3 and the 30 to inform this decision at all. What I'm doing is I'm waiting to feel some kind of trigger with my sniper judgment, which says there was something about this upside movement that makes me feel like somebody just put a lid on that. Like that move is that peak of that is going to become resistance for the near future. Now, why does it feel like resistance? In my view, if I saw price action previously have been going up and it has those little turning points in the RL10, and then it came down a certain distance and then gave me the reversal, and then there's my SSC. One of the things that I'm doing in my standard trade framing is finding every one of these things that were a peak and establishing that as a new test level. So when this thing starts taking off, remember these have already happened. Damn it! All of those things have happened, and there's maybe this is the 10-day high, or maybe no, I couldn't. Maybe that's the 10-day high, but all of these places where there were turning points in the RL10 is a potential place that could be the limit. At each one of those places, instead of going higher, it went lower for a spell. Instead of going higher, it retraced. Here's a case where it just went sideways. Every one of those was a place where price behavior changed until further notice when this new price act. So here's the vertical blue line that told me I'm stalking, right? Or maybe it's here. Maybe the fact that it broke support levels is triggering me, and I'm seeing 1 day down, 2 day down, 3 day down, 5 day down, and then it holds finally down here. I can now see all of and this is the place where it broke. That's the place where it broke. That's where it no longer made higher lows. This thing just kept coming down to here and created that harsh winter. So now, when I made my entry, and it starts moving up the stack, I already know where all of these little test areas are. And the mind state that I want to be in is the 2R battle drill. I want to be in the 2R battle drill mind state to be ready to react to each of those potential resistance places. I know that. I know where those are going to happen from the moment that I enter. I knew that on the way down that someday price is going to come back up and retest all of those locations. And so when I'm rehearsing the 2R battle drill during my prep phase, I know where those things are going to happen on this particular frame. And each time that it doesn't fail and instead it successfully breaks through, then that's just more positive information about how much power there was in the buying pressure to drive this thing back to that fair value. So when this thing opens inside, now when this trade opens inside that setup bar in the orderly move, this whole mindset is my routine, normal trade mindset. Once it leaves the yellow zone, it gets into the green and is going up. And then this thought process of how I pick a routine managerial exit to give me enough buffer to let the engine of growth work is normal. And when that thing hits some resistance, and I anticipate it hitting resistance at these price levels, then I invoke the 2R battle drill mindset in order to decide how much to give back compared to that that long-term Bollinger Band mean. So the exit that I'm choosing is simply treating that almost like an inverse trade, where that's how much from the peak I'm willing to give back. And if I let it come all the way back to the Bollinger Band mean, then why did I go through the pain and suffering of taking the risk to buy it here and let it go all the way to the top just to watch it come all the way back here? Then all I'm going to capture is whatever the difference between my entry and the wherever the Bollinger Band mean is on the next one, and I will have given back that much of the maximum available move after the fact, because I did an exit and time passed and price came all the way back to here. So I ended up giving back that much of the maximum favorable excursion. And if I gave back 2/3 and only kept 1/3, then I start feeling dumb. I don't like that feeling. So whatever the maximum peak of that is, and I think about where my stop is. Once my stop is at least at break even or no lose plus dinner for two, I got to say, how high did that have to go in order for me to ensure that wherever my stop was, at least I'm not losing money. And now I can think about the size of the favorable move to wherever my stop is. And if that turns out to be 3 execution R, then I want to keep one, or I want to give it one to play around with, but I want to preserve 2/3 of that move. And that's the mindset that's with me every time I see that thing peaking. As soon as it peaks, I can quickly detect where is the least surprising reversal move. Is it the Bollinger Band mean? Is it my normal managerial stop? Do I want to preserve any more of that exceptional move? So now I want to talk about abnormal price behavior to answer Jay's question. That's the longest setup known to man. And that is, what do you do when you have you have an opening that's outside of the yellow zone, right? So all that previous discussion was about normal price behavior. Now what happens if I open here or open there? Is that good or bad? Well, I treat those as that's abnormal conditions already. So part of me says, how big is that gap? Because it opened here and it closed there. That's now the gap. If the gap is greater than average, then I have reason to believe it's a big day. So now I'm even more eager to trade, but I don't know which direction. So I have to say from the open plus range stat minus range stat is more likely today than normal because I have an abnormally large gap. In this case, it was up, and it's exactly the same feeling if it was down this way. It could be equally large in either direction. There's no predictive follow through on that. So, my standard practice on that is whenever it opens in the green or the red zone, is wherever the opening was, I just put an MMRB like an R10 in either on either side of that opening. Now, that gives me my new tactical trade frame for these abnormal conditions because it may not wait for a 3 minute move. I mean, the 3 minute bar. Like if I'm in normal conditions, I can wait for an OR3 and then on the intraday use the OR3 as my breakout box. And normally that means it gapped down to here and I get some orderly move. And there's my lower limit and up it goes. And there's my OR3, my little OR3 range, and it's reinforcing yesterday's low as the downside. That becomes my favorite entry intraday on the long side. Or there might have been a WMB3 price action in here for the normal, but it's outside. So I override all of that with this. Here's the open, and I put an MMRB R10 on either side of it. And now I have an increased possibility of a range stat move from that area, which means here's 1 unit of risk. That's one R10. That means there's a possibility of +9 that way and +9 that way. Like if it opens and then immediately starts selling off, then there's potentially 9 more of these that I risked to the downside, which I really think of as a group of three, another group of three, and another group of three. So 3 sets of 3 as provisional big moves to the downside. By the same token, uh, where else could I establish specific price levels? If this is my range stat analysis for the downside targets, and I have this gap up here, and this was the mechanical entry, what used to be resistance could now be support. It could also be a target to the downside. Yesterday's little high is a place where price could get to and then find support and go because there's the implied strength of the gap up saying there's a bunch of buyers. And if it came all the way back to here and held, I'm still going to look at that as a support level because it used to be resistance. But if that doesn't hold, and all that is I'm fading the gap. So if I had my tight little wrist box around the open, I'm just fading the gap. There's my gap fail trade just back to here. That's target one would be the previous day's high. And then I could go, if that fails, the next one would be the close yesterday and then the low yesterday. Those are all, those are the first 3 targets that on a gap up, I think can fail to the downside that are driven by yesterday's price. So I have the range stat first, then I have the price targets that come from yesterday's bar, and off we go. And then the upside simply says, hey, what were the previous uh, price ladders of support and resistance on the way up? That's what it looks like on the way up, is wherever those previous price ladders were. I can now say it could get to here and to here and to here. So I always have something like whatever price I'm at, I always have some kind of price ladder in both directions, that is the next test of price action. Now, Joe's question about the 3 minute and the 30 minute. If I see that big gap, I guarantee you I am on the 3 minute. Almost looks like a nuclear explosion. Because the exceptionally large gap says it's appropriate to trade that even more tactically. But when I set up my trade frame overnight, I was looking at support and resistance levels based on the 30-minute bar. So wherever those 30-minute turning points are, I plot those on the chart. And when I'm on the 3 minute and I see those purple lines, I know that according to the 30-minute excuse me, according to the 30-minute bar, those are going to be significant price levels that price has to contend with from that higher time frame. This tactical trade is now taking into account where the next higher time frame or two, where those guys were bailing out. So that's how price action on the 30-minute is influencing my 3-minute. Check or hold. Now, blue line. There's my
And
mechanic. Yeah, go ahead.
did you say so when you see a large gap at the open like that, are you
Yeah.
entering just wherever you can get in and
No,
then
no,
putting
no,
a
no,
standard
no,
risk
no,
box where
no,
you're
no, no,
waiting for
no,
this? Okay.
no, no. I enter based on what I said, which is that when I have a large gap, I'm using an abnormal condition trading rule. So I don't immediately buy it. I just notice that's where it opened, and where I enter is I immediately construct this box of plus MMRB and minus MMRB, and I wait for that price to leave this box. When it leaves that box, I now have directional information. It moved more than one risk box from the open. And then I use that as my stop. My initial risk is now this, and it's moving that way. And as soon as I can, I get that to no lose plus dinner for two. But if it breaks out this way, my stop is also at the open and up it goes. Then my job is to get my risk from here to there. My target on the downside is yesterday's high of day on day -1. And then the second target was yesterday's close. So if that's my risk box, that's how good that trade frame is. In the cases I just drew, it's 5-1. How far could it go? Well, because it was a large gap up, I'm entitled to say this is a day where it could be a range stat. So I'm going to end up going to wherever the range stat is. I know that and I know all that information right there whenever the gap happens.
Okay, so the open is your stop, and once it moves one standard risk
Yeah,
beyond that, then that gives you your direction,
yeah,
and you're entering at that point.
yeah.
Okay.
So in my mindset, what is standard about this, standard work for abnormal times, is that the idea of a trade frame box is still in place. On a normal open, which opened inside yesterday's yellow zone, right? The box is this frame right here, the standard normal mechanical box. There's my mechanical entry, and then there would be my mechanical risk. And if it goes this way, there's my entry, and then that becomes my 1R risk. The idea is that the trade box is established according to a rule. In this case, with a normal entry, an orderly entry inside yesterday's range, then any move outside of the box signals some kind of new information, new perspective. Yeah, Greg asks, while we're here, what about standard positioning size? Hey, whatever I came up with over the weekend, there's some that for every one of those things on my list of 30, I have a standard position size based on a $400 risk per trade. Like, uh, it is normal to see the R10 on EWZ fluctuate between 10 and 30. So I just say 20, and my standard position size on EWZ intraday is 2,000 shares each day, every day, all day, forever and ever on 3-minute charts. And then I have a standard bet size. Like, I'm not calculating what's the maximum position size I can get for this thing. I just personally go with the standard bet size so I don't have to think about it. I can rehearse that and there's no surprises here. Whether that was a breakout from normal conditions or whether it was this gap up, what stays the same is the fact that I got a trade frame up here the same way I have the trade frame down here. But I guarantee you this is a lot smaller because the width of that box is 2 RL10s. And my stop when it breaks out this way was the open. I would love to see that thing fail immediately because then that was also the high of the day. And then one risk box goes in my direction. Any violation of that price is a new high of the day. It tells me that the thing may be going up. So I only need that much buffer once that thing is fallen. And then the target is yesterday's high, yesterday's close, yesterday's low, plus whatever the range stat was, whatever price that is, it's 9 times almost drawn to scale. So I've got at least 4 price levels that can act as targets if that thing gaps higher. That's a large gap and then fails. There's my execution mark. But what's standard about this is the concept of the trade box, the trade frame is what makes this standard work. Now, what if it's not a large, what if it gaps outside, but it's not a large gap? How could that happen? Well, because maybe yesterday was a doji and the yellow zone is trivially small, but it's not an orderly open and it gaps up right there and is starting to go. Now, what do I do? Well, I want you to remember, I still have to have a 2-to-1 to my previous price target. So now I can do the math. And the math looks like this. Oops. The math looks like this. The mechanical entry was here. The mechanical risk was there because the price bar yesterday was like that. And this thing gave me a risk box like this. And the RL10, or the 10-day high, excuse me, 10-day high was up here. And I notice that there's 1, 2, 3, 4, 5. Now I have a 5-to-1 trade on a standard setup. But now what I want to see is it opens inside yesterday's range and it breaks out, and now I'm long. It's easy. But instead, it broke out here, but it's not a large gap. So I have to know, if that's my close, how much does this have to gap up to constitute a large gap? If it opens higher than the limit of a large gap, then I know that I'm going to put the bracket of the R10s on it, and I'm going to play that breakout with abnormal rules, like I just described. That's this trade. But what if it gaps less than a large gap? Then it just looks like noise to me. This just looks like part of a normal move up, and it opened here, and now it's just going to be part of a normal move that's going to find its way eventually to the previous 10-day high. So here's what I do. I know that there is some price level between my target and my risk in which this is still a 2-to-1 reward to risk ratio. So I know that there is some maximum price that if it gaps inside here, I can just buy it. I should probably draw it here in just a minute. If it gaps to here, right to that line, and I still use this as my exit, and then that becomes my 1R, that I still have 2 units of reward. Now this is a 2-to-1 instead of a 5-to-1 because of the extra gap gets added to the size of that risk box. This used to be my risk box when it was an orderly breakout, but because there was some gap up, there's some maximum price that it can gap to where I can just automatically buy it, and I still have a 2-to-1. So you know what that price is on swing trading one day at a time, because you know where the large gap has to be in order to invoke the abnormal emergency override. As long as it gaps less than that above the high, I know what the maximum limit is that I can just routinely buy it and still have 2-to-1. My personal preference, until you've traded this 1,000 times, is that if it gaps outside yesterday's range, ignore it, leave it alone. Why? Because there's something new, strange, crazy, and exciting here. And that is already not a standard, basic, normal trade. There's something new and exciting. Leave it the fuck alone. You practiced setting up 30 other symbols or 10 other symbols for an orderly exit. Until you master the orderly opening and the routine takeoff, you're not ready to do these other things because of the extra pressure. in my opinion. But when you feel you're ready to try it, that's how you got to do it. You got to say there's a normal gap up, which is not a large gap, and it's out of the yellow zone. And I can buy it as long as I still have 2 to 1 using the prepared lower limit as my exit. Or it's an abnormally large gap, and now you can establish your trade box with a MMRB bracket, and then you can trade it in either direction. And the gap fade is the high of the day, the close of the day, and the low of the day from yesterday as my 3 price targets on the way down. And I have to get my risk to no lose plus dinner for 2 right away. But if it breaks out to the upside, I also get my risk to no lose plus dinner for 2 right away. And I use previous resistance levels as price targets on the way up until it gets to the 10-day high. That's how I say it in one breath in a paragraph. To break that down into components took me 40 minutes. No, it took me 50 minutes to cover that. That's how much information there is in that little paragraph that I said. That's exactly how I trade. It took me one breath to say that in 3 sentences. It took me 60 minutes to diagram all of the components of that answer, and all of that gets compressed into one paragraph in one breath, and I know exactly what I'm doing because all my behavior is anchored into the idea of the standard work for normal times and standard work for abnormal times. And it's all based off the idea of a trade frame that gives me at least 2 to 1 in each direction, and I can apply it to the circumstances without fail. So my advice to you, if you want to learn to trade that way, is start with normal condition. Normally, it opens inside yesterday's range. So trade it like normal conditions and wait for the breakout according to the trade frame that you established. But if it opens outside yesterday's range, leave it alone until you have 1,000 trades from normal conditions. Then you can worry about what to do when it opens outside of those. When you're ready for advanced techniques, that's where you start using the gap stat and framing the trade right from the open. Why would you be interested in doing that? Because the standard work is that wherever it opens, and it gives us a harsh winter, and then that thing reverses to an SSC. The SSC gives us normal work, and it leads to, and after a successful SSC, if I get a successful SSC, then I have the possibility of pot of twos all the way up to wherever it's going to stop. But the precondition for the SSC, which is normal work, standard work, the precondition was a harsh winter. If this is intraday, how far does that have to go? 1.5 frog boxes, which is about 5 RL10s, which is 1/2 of a range stat. It takes that much of an adverse move to trigger a harsh winter conceptually that allows us to think the SSC was an exaggerated sale, and maybe there's this room back to the previous opening and then beyond. This is the normal work. This is the abnormal work. Here's what it takes to get this trade is that if I had an abnormally large gap, and there's my open, if I put my little trade frame box around it, I have a 4-to-1 trade back to the conditions that will probably lead to an SSC in the near future. So when you watch the 3-minute bars right from the open, what do you always see happening? A lot of the time, you get some kind of opening, you get some OR3, and then you get some decisive move down or some decisive move up. What's the deal with the OR3? The OR3 simply takes that opening range 3. That's another way to establish the concept of a trading frame right from the open. And after 3 minutes, you can start playing that trade. That may lead you to a harsh winter, which leads to an SSC, but the OR3 is an advanced technique. Otherwise, you should wait for the 30-minute bars to give you something like a 1, 2, 3 or an SSC pattern and trade it on 30-minute bars. But if you had a large gap, you're entitled to believe this thing could be radioactive from the opening, and then you could maybe use the MMRB bracket or the OR3 and fade the gap or follow in support, or on a big gap down and you see that thing starting to reverse, you might go WMB3 right away and get into that thing and not even worry about an OR3. All of those are advanced techniques from the opening. What I'm trying to teach you with the foundations course is that between the open today and the close today, there's 13 30-minute chunks. And you don't have to chase in that first 30 minutes. You can wait to see this thing. Okay, here was the opening, and it did this, and here was the close on your first 30 minutes. And then in the next 30 minutes, it opens where it closed, and it did this, and it was a doji. And then maybe in the next 30 minutes, it opens here. And you might say, you know what? One, two, three. There's my entry. There's my low of the day. How high could it go? Low of the day plus a range stat, valid trade frame, and I can get in. Hey, if this thing starts moving up, all I have to do is see how high did this thing go from my open until I just decide to sneak my exit up into there. And now what do I have? No lose plus dinner for 2 on a 30-minute bar. And I might want to say, Let me take that and go down to the 3 minute and just see what's going on and use from the 30-minute bars, I've got all my price levels from previous support and resistance. And then I can go down to the 3 minute bar and start micromanaging this thing a little bit and see it coming up and up. It's coming up to, it's starting to stall before it even gets to that next resistance level and starts to fail. You know what probably happens right there? Is probably the RL10 on the 3 minute bars probably starts doing this. So what is my exit there? If my PSAR is here, that's my managerial exit. And the dragon on the 3 minute may be here, and it's getting ready to roll over. My new stop, instead of being the PSAR, as soon as that thing peaks, my stop becomes the upper skin of the dragon on 3 minute bars. And now I preserve all of these gains. I get the extra payoff. Instead of taking the PSAR exit, I get the dragon skin exit. And now I've captured that extra little piece of goodness. So you don't have to get that right in here. Why would I want to trade in the first 30 minutes? What would cause me to want to trade inside the first 30 minutes? Oh, I know, the largest gap. Because that's the most likely to get a range stat move. So I can instantly go to the opening and put my little trade frame on it and trade that one special while I'm waiting for the routine ones just to unfold on the 30-minute bars. If you go back and take a look at Friday's price action, what you would have seen was a bunch of things that on the 30-minute bars look like this, then had a big sell-off or a gap down, and then started doing this on 30-minute bars. As soon as I see that, I start thinking, well, shit, here's my stop. And here's my box. If it just gets back there, I can trade that. That's my trade frame. And it was created by the harsh winter of that big sell off. That's like one big red candle, that adverse gap. What about ones that just do an orderly little sell off and now it's 3 hours into the day and gives me a 1, 2, 3? I invoke time, will, pattern, and money. The sell off is here. There's a 1, 2, 3. The MACD histogram probably went from winter to spring. And now maybe I can trade that. And then if it breaks out above yesterday's high, what do I have there? If that was yesterday's high and it breaks above yesterday's high, what do I have? A mechanical entry. Where's the 10-day high? Over here? That's my entry on the swing trade, and all I was doing was trading in the yellow zone. That's the connection between the 3 minute, the 30-minute, and the daily bars. Yeah, a large gap is a gap that's greater than the gap stat. Now, $400 risk on the additional SSC positions. You mean the COTA 2 positions? So now we're going to think about standard work for risk. Risk per trade. So there is some rising scale of risk that is justified. And there's some level that is production, low rate production, which is probably 1/3 to 1/2 of production. And there is prototype in here. So if I'm using normal conditions and abnormal conditions as my sorting, I got to know for each pattern and each strategy, where am I? Where in my little risk? So for me right now, if I see harsh winter and an SSC on 3-minute bars and Kata 2 and collapsing dragon, this whole package right here is the foundations course. So and if my production level is 400, then I trade each one of those trades at $400. Now, if that was a large gap up, maybe if I'm just learning the large gap up, like here was yesterday's range, and this was a large gap, and I decide on the first time I'm ever going to do that live, I've already done the back testing and the paper trading. Maybe I've never traded that before. Maybe I'm already at production level on the foundations patterns. So I'll trade those at production level, and I'll trade this at $1 or 1 share until I get proficiency with live trading with skin in the game. And I'll trade this with 1 share until I close it. And if it was a successful trade, it probably went as far as a harsh winter, which made it successful, which now makes this SSC a normal entry. And I trade that at 400 because I'm at production level of risk on that set of patterns. But just because I'm trading this at 400 because it's in production mode doesn't mean I'm in production mode on there. So the question is, how long does it take you? How many trades do you got to make before you can jump from prototype into production? I say 1,000 trades. Why? Because all of our data says it takes about 600 to 750 trades with skin in the game before you beat yourself into submission and just trade your rules without thinking about it. It takes that long to hammer the monkey out of you. Now, maybe you're faster, maybe you're slower. But the answer to your question is I trade it at the appropriate level of risk for the strategy and the pattern and the time of day, the time, will, pattern, and money thing. If I'm at production level here, now I have something to rely on. Maybe I can start adding this to my arsenal. Check or hold. And maybe your production level is 100. Then now what I like about the round numbers is if my standard production level is 400, I can take a half a risk and just trade 200 because I'm worried about it. It's okay, 200. And I can trade 100 and 50 and 25 and 10 and 1. That's just a nice orderly mathematical level of trading. And then you decide where in that scale of uh, research, prototyping with what, and this first one is where you have skin in the game. And this next level is when you're in production to make R, to feed your family. All of the space in between those is your scout mindset. Is you're trying to qualify a production level. You know when it's in production? When you don't mind having the robot just trade it. Like what Luke is doing with the 5 minute Aussie and the DAX and all that. When it's boring and it's a machine shop and you're just trading at the production level. And all you're doing is taking the daily performance and looking at the daily R as the aggregate trade for the day, and your system is to trade all of those signals. And then you just care about, hey, what was the net for the day? And then that becomes your meta system. And then you start managing that. To do that, you got to have a number of different proven production systems. And your scout mindset is when your ideas, the scout is there to learn what could work in production and move things from the idea phase into test phase, learning phase, scout phase, and then into production. And scaling from $1 to whatever dollar factor you declare is production is your choice. What does it take for you to go to the next significant level to add enough stress to see if you can still handle it and that it still works? You just got to decide what those are. How much more do I have to increase in order to take it seriously and study it as a scout with skin in the game? And then at some point you declare, all right, that's the level of production I want to be at. And then that's your chip stack. And now you're just throwing a chip and standard work, standard position size, and all that other shit. You know what else gets you to standard position size? When you decide standard risk per trade, and then your standard, like an R10 or an R5, and just say, I'm just going to pick that number and stabilize it all week. And I'm going to use a standard position size for it all week. So I don't have to think about that while I'm trying to trade the rules. The rules that you're learning that require discretion is how to adjust your stop, how to establish and then adjust your stop. That's where your discretion, you want to end up getting to rules to manage your exit because this is price contingent. Price action contingent. What price is doing and how it behaves, you don't know. That's why you have to wait and see live dynamic action. But whatever that price action is going to drive decisions to adjust your stop to a certain level each and every time. Now, maybe it's just hey, I'm just going to use a trailing from the highest high. That's your rule. You've already decided that's your rule. No, I'm just wherever the PSAR is, that's my rule. You know how I know that it's not your rule? Is because you see the PSAR, but you're moving stops around higher than the PSAR. So you're using discretion until you can convert it to a rule. And then you're moving it by rule, and then you aren't worried about it anymore. Good question.
Yeah, when you say standard risk at an R10,
Yeah.
you like to have your position sizing risk be greater than, or the dollar value be greater than your R10. The R10, it could be less than your
Yeah.
execution risk.
So I
So
use standard risk as in two different ways. One of
okay.
them is dollars per trade, and that is a function of where am I on the risk per trade scale. I'm either investigating, testing, or in production. So there's some number. So that's a standard risk. The other one is standard risk for execution, and that is driven by the pattern, and that is this. That pattern is my decision on where to normally enter and normally exit. Okay. That is standard execution risk. Now I'm going to compare that. I want to compare that R10. R10 comes from the statistics of daily price action over the last 30 days, right? So I take the last 30 days of range, and based on how that behaved over time, converts to the range stat. And then 1/10 of the range stat gets me statistically to the R10. And now what I'm going to compare is what is the execution risk to the R10? Sometimes the R10 is wider. If the R10 is wider than the risk box, that's really good. That means the doji or whatever, the price action was so narrow that I only have to take that much room. Now, here's why I say you got to compare those. What if this was only 5 cents and your R10 was 10 cents? And what if you were accustomed to saying at $100 of risk per trade, I was used to managing 1,000 shares. But now I notice that my execution risk is only 5 cents. If you read the work on this on the internet or at the Tharp Institute, we'll say, well, take your $100 and that's your risk box, and it's only 5 cents. And now you're going to trade 2,000 shares. but you've only been normally trading 1,000 shares most of the time. The last 500 trades, you traded 1,000 shares. And now, because of accidental circumstances, this thing compressed to a tiny little thing, and it's only 0.05. And you just, like a blind monkey, you say, oh, I take my execution risk divided into $100, and I'm supposed to trade 2,000 shares. No, you're not. That's a decision. So I compare the statistical R10 to what the execution risk is. And what I say is, whatever your execution risk is, set that equal to point 0.6, or I'm no, sorry, point 0.2 of a position sizing R, which means I take 0.05, multiply it by 5, and my position sizing risk should be 25 cents. And now divided into $100, I'm going to trade 400 shares, and I'm actually less than what I'm accustomed to trading, and I'm happy. I'll trade 400 shares because this thing was so small, I'm worried about it. Now, if the risk box, if the risk box is larger than an R10, what if you've been accustomed to trading the R10 level of risk on a bunch of different symbols? And here's one where, oh, the R10 is inside that risk box. And you say, oh, well, I'm just going to, it moved an R10 against me, so I'm going to exit because I set that equal to 0.2 because I'm used to trading the R10. That's a misunderstanding of the R10. And the R10 is simply giving you a reference against which to judge. This is still your execution risk. That's the first price that tells you that this hypothesis isn't working. This is the noise right here. So don't get lulled into always trading the R10. You got to compare it to the size of the PSAR flip.
So in that scenario, you'll reduce your shares based on the exit.
Yeah. So
Exit.
now this is where this gets into effect on the 30-minute versus the 3-minute. The R10 is really designed to maximize your position sizing and your trading activity intraday tactically on 3-minute bars. Well, what if you're doing the 30-minute bars and only occasionally you come down to the 3-minute bar? The size of the PSAR flip boxes are different. It's the same pattern, but the size of the PSAR flip boxes are different because the size of the moves are different on the 30-minute versus the 3. So what looks like it is not unusual at all to see the R10 equal the execution PSAR flip box on the 3-minute bars. But on the 30-minute bar, it's not unusual to see that. So if I'm trading on the 30 minutes, that's like appropriate for the overnight swing. So I'll just say, all right, that's $1, and that's 25 cents. So my $100 of risk, I'm going to trade 100 shares on this one for my swing trade. And then I go, it's really working. I'll drill down to the 3-minute and say, oh, on the 3-minute, I can be trading 25 cents, and that's equal to the R10. Good, that's normal. I can add 300 shares for my turbo and fill up my 100 easily. And now I got 400 shares going up the stack. When this thing fails, I get rid of 300, and now I'm back to just trading 100 shares on the 30-minute. So that's not a bad way to look at this. Use 100 shares for your initial increment in on 30 minutes, knowing that on your daily, you can get, or on your intraday, on your 3 minute, you can get extra size for your turbo and your core. And you might say first turbo position, second turbo position, full turbo position, all in. There's my 4 units of risk. And that's maybe for span of control purposes, that's the only 3 minute trade I'm taking. So there's some flexibility in here, but just realize that when you're combining two different time frames, you're maximizing the cognitive complexity of your system. When should you start doing that? After 1,000 trades, when you're at production level on 30 minutes. So do you have to wait till you're at production level on 30 minutes before you start trying to? No. Where are you on the scout mindset and levels of risk? If my production level was 100 on the 30-minute production and I wanted to start monkeying around with the 30-minute, maybe what I do is bring the 30-minute bar down to maximum scout and trade $25 and then trade 1 share on the 3 minute and see if I can handle that. So I'm not blowing up my account. If your intention is to start trying to trade with those in combination, then you're probably no longer trading that one at production level because you're trying to see that relationship. Maybe you can handle this at production and then just have adding 1 share on the turbo. So maybe trade the 30-minute at production level like you normally do and just trade 1 share on the 3-minute bars till you get used to going back and forth between the 3 minute, but you're not losing the dollar value gain of a production level system. So you got to think about this as how do I add complexity to my game without giving away all of the money that I worked so hard to accumulate? What I'm trying to explain is this nuance about the R10 as a guide to not getting too large. It's also a guide to saying, how small can I routinely get as I start going down in time? And now suddenly the size of the PSAR boxes were really small compared to what I was comfortable with on the 30-minute bar. Maybe it's only the 10-minute. Maybe it's the 3-minute. Maybe it's the 1 minute. There is some minimum manageable risk box that you can trade comfortably. The R10 is a statistically sized box that gives you important information. You know that if you can trade with the R10 comfortably, it's because there's 9 of those boxes to a range stat. That's an important number. And so maybe it's the R10 or maybe it's the R5. The R5 is not a bad box. You know why? Because the R5, which is 2 R10s, there's 4 more of those to a range stat. Why? Because there's 10. And if I went from the low of the day up to R10s, then there's 8 more of those, which converts to 4 R5s. So now you have a statistically calibrated yardstick. It's like the metric system with millimeters and centimeters. Oh, there's 10 millimeters in a centimeter, etc. So now you have a mathematical basis for judging, is that a manageable trade? And I can look at any time frame and I can look at the PSAR box flips and say, oh, on that time frame, That looks like a real, I wonder how big that bar really, how big is that really compared to the range stat to tell me if that thing is worthwhile trading? Oh, I can see two of those, and that's an R5. I'm done. Good. You could actually, if you were accustomed to trading the R10 and never taken more than an R loss, you could certainly trade the R5, double the size to aim for four and accept two and settle for one. That's easy. No, I start on any time frame with the PSAR flip box as a reasonable pattern to get in on that time frame. When I see the PSAR on that time frame, that's the first time that I look as a mechanical signal to get. That's the first mechanical signal that I can use to get in. Is this price? Price went down here and it went that way. That's my first choice for a mechanical trade frame on any time frame. If I'm trading that on a 2 hour bar, that's my mechanical entry and that's my initial risk. I then have to say, how wide is this box in terms of real dollars? And then from the, if that was the low, I can take how high is the range stat for that day? If I'm on a 2 hour bar, I'm trading much faster than swing traders. Check or hold. I'm trading much faster than swing traders. I have 4 2 hour bars inside that daily bar. And if that's what it looked like, then that was my entry, or I'm sorry, my open, and that was my close. And this was the high of the day, and this was the low of the day. That's what the daily bar looks like. And that's what 4 2 hour bars looks like compared to that one. And what does 13 30-minute bars look like? And what does 130 3-minute bars look like? And somewhere in here, as I dial down the time, I'm going to find the PSAR box flip that is that feels like the easy tradable move, the easy tradable time frame with manageable time increments to keep making the decisions. And then I want to know, how big is that box in terms of dollars, and how big is it compared first to the range stat? Why? Because the range stat from the low of the day, no matter what time frame it is, that's the maximum reasonable intraday move. And if this risk box gives me at least two to the range stat, I know that this is a tradable pattern intraday. And then if that was 2 hours and that's the width of the execution box, I can now go down to the 1 hour and the 30-minute, all the way down to the 3-minute. I know that that is a manageable box. Maybe that's my position sizing risk box, because maybe that thing is 5 times larger than my R10. I can just use this as my position sizing box, but I can't always use the size of the PSAR box for my position sizing when I get down to the 3-minute bar, because that thing might be 5 cents today. And it's my position size is enormous compared to how quickly and how frequently that comes in. On a 3-minute bar, maybe one trader from an institution comes in and makes a huge buy or sell and smashes the prices. And now I've got the maximum position size at a maximum surprising volatility. And I'm smoked. So you got to work your way down to the time frame that is you can comfortably manage intraday. Normal checkpoints on this are the daily bar, the 2 hour bar, the hour bar, the 30-minute bar, the 15, the 10, the 5, the 3, the 1. For me, the 3-minute bar is more than sufficiently fast. The 30-minute bar is much slower than the 3-minute. It's a different world altogether. And the 30-minute is a world of difference from the daily. And it's much better than the hourly or the 2 hour. Most people just go, hey, go from the daily to the hourly and from the hourly to the 5-minute or something like that. I don't know what most people do. I don't care. I just know that there is a significant difference between the 30-minute and the daily. There's 13 times more bars to work with. That's significant. There's 10 times more bars to work with here. So that looks like reasonable checkpoints to me. And then when I go to the 3-day, that really reduces the size of the gap. And then the 9-day is plenty of time. And both of those are different than the daily and the weekly and the monthly. That gives me the advantage of being able to work in the shadow between the normal sized time bars. That's why this is advanced day and advanced swing and hybrid trading. But it's 1,000 trades to build up proficiency. Go into the wood shop and work with power bandsaw. How many projects or how many cuts do you have to make without cutting your finger off before I feel comfortable letting you work on the saw by yourself? 1,000. Make 1,000 cuts. Why 1,000? Because after 100, surely you should be able to not get lost in the details on one cut. All right, so multiply that by 10. I say 1,000 cuts. History shows it's about 600 to 750 before guys just have internalized it. They notice that they've internalized it without thinking about it. It takes 30 trades of careful attention to begin to apply statistics, but maybe you need 100 to really be satisfied. And it takes 600 to internalize it, and it takes 1,000 before I believe you better have it by 1,000 or something else is wrong. That's how many trades with skin in the game. What's the minimum size trade that you need to have on for skin in the game? I declare it's 1 share. That's the lowest level of live trading that you can do to justify the claim that you have skin in the game. That's why I teach trade 1 share live and learn something from it. That's much better than back testing. The information that you get from 1 share live forward trading is not available to you with back testing or paper trading. That's a fact. All right, that's everything I want to cover today. There's a ton of stuff in here.
Thank you, Ken. There was at least 5 different lessons in this
Yes,
2
sir.
hours.
Yeah. If you come here and you're listening to these and working on them, you're doing the work. You're getting the advanced day and swing and hybrid, building on the foundations. So I'm giving you those workshops for free. in the FAQs of foundations as you're doing the work. That's our secret. There's so much material in those workshops, though. It's better for you to explore that with a starting point of your question from the foundations. Because I don't know where you are in the foundations until you ask questions. So if the foundations material is here and the advanced trading for day and swing and hybrid is here, and that's swing trading, the hybrid is up in here. I don't know where you are in the foundation's basic material until you ask a question on the boundary and say, oh, that was about day trading, or no, that was about how to apply that pattern on the swing trading. So when I answer you that question, you're moving out of foundations and into swing trading. So it's important for me to make sure that you're satisfied with the basic material of foundations. And then that should be good enough. But if you have questions out here on the boundary, it's because you're looking to specialize in one of those two. And when you get those, you're actually moving towards the hybrid. When you ask questions about 3-minute and 30-minute, you're already talking about hybrid trading, which is the highest form. Foundations, and then there's day trading and swing trading and core trading. That's the next level up. Hybrid trading is blending multiple time frames. And top level hybrid trading is you're doing all of those at once into a meta system, and you are moving seamlessly and in an integrated way between day and swing and core, anchored into the principles of the foundations, but then with maximum adaptive flexibility so that no matter what the market does, whenever it changes, there's a way to express that change in one of those systems using foundational principles and then integrate later. You'll be able to traverse any volatility in any market. That's where you end up getting to. All right, that's everything for today. Take good care.
Thanks a lot. Take good care.